All right, in this lesson, we're going to talk a little bit about the different types of tests auditors can use during their audit procedures and audit engagements. So we're going to look at these three. Now, this is kind of the basics of them, so this will give you kind of the introduction to these tests, and then in future videos, we'll talk a little bit more about each one of these tests in detail and what we would be doing when we are performing these tests. So again, this video will give you kind of the introduction to the tests that we use as auditors. It won't give you all the specifics, but we want to give you a kind of a firm understanding of the tests that auditors can use or have at their disposal when they are doing an audit engagement. So the first test that we're going to be talking about here is the risk assessment procedures. Now, these are not necessarily, I would say, tests, but they are a type of test or a type of procedures that auditors perform in order to understand how the company works, how the entity works, how management works. It kind of gives us an overall picture of the entity itself, which is important. If we're going to want to test something, or if we're going to do an audit of a company, we better know how that company works. And so the ways that we can use risk assessment, or the types of tests that we would be doing or procedures that we would be doing, include inquiries of management, as well as other individuals within the organization. So we might go and talk to management, we might talk to some line workers to kind of get an understanding or overall sense of how the organization runs. We also might do some what we call preliminary analytical procedures. What that means is we might do some ratio analysis, trend analysis. We'll talk a little bit more of those analytical procedures over here when we talk about substantive procedures. But we're going to do a little bit of ratio analysis. And what ratio analysis is that we're going to look, let's say, for instance, net profits this year, and we're going to compare them to net profits of last year and see what the differences are. Okay? If there are major differences, that kind of keys us into different areas of the audit that we're going to need to pay attention to, or maybe we can ask questions of management right away in order for us to get an understanding of the entity as a whole. We also might do a little bit of what we call observation, so observe how things are done in an organization. So we'll just go out, and I wouldn't say necessarily sit, but sit there and watch how things are worked, watch how things are flowed. It's kind of interesting to understand how things are done in an organization, and kind of just sit back and watch it happen so that you kind of know what goes on in the organization. And then the last thing that we might do is called inspection. So we might inspect things to see if it's truly theirs or it's truly there when we do look for it. So, you know, for instance, maybe they say that they have a facility down the street that has a big warehouse and it holds all of their inventory. Maybe we just take a look at it, make sure it's there, make sure that they have access to it. It wouldn't be necessarily a test of actually counting things, but just making sure that things are there. We're inspecting them, or maybe inspecting documents. So we're kind of getting an overall picture of the organization when we do risk assessment procedures. Now, what that helps us do is exactly what it's called, risk assessment. We're going to assess the risk in an organization and see, maybe as we go through the planning process of an audit, what we need to key in on at the end of the day. Okay, so that kind of gives us an idea there. Now, once we do that risk assessment and develop that risk, then we do something called tests of controls. Now, the tests of controls are audit procedures performed to test the operating effectiveness of controls in preventing and correcting material misstatements at the relevant assertion level. What does all that mean? Well, this is what it means, is we're going to go out and we're going to do the test of controls. Well, what is a control, or what is an internal control that we're trying to test? Well, the internal controls would be like this, for instance. In order for a check to be issued for more than $5,000, 2 signatures must be on the check. In order for someone to print the checks, they must have authorization to print the checks on their computer. So let's just say for those two, let's start with the $5,000. We might go in and see checks that have cleared the bank and see what the amount of the checks are, and then we may want to see a copy of the checks to see what the signatures look like. If there are 2 signatures over 5,000, then it passes. If there's only 1 signature and a check was 5,000, then we have some issues. That control, or that test of that control, fails, okay? So we're going to test the controls. We're not looking for accuracy in the numbers though. So for instance, for that $5,000, we're not looking at whether or not that check was properly written for $5,000 or properly written for $9,000. What we're trying to look at is whether or not 2 signatures are there for any checks that are above and beyond $5,000. We'll use some sampling techniques, so we're not looking at every single check that's issued for $5,000. We're only going to look at a sample of them, but we're going to check that to see if it's within our tolerable misstatements, and if it's under our tolerable misstatements, then we're going to either pass it or fail that effectiveness of the control. Is that control working effectively? Now, we might also, again, going back to another example, is in order to print checks, you must have the authorization key to do that. So we might try printing checks from another computer that doesn't have the authorization key, and if it does, if we're able to print, then we know that that control is not effective because this person who's on this computer who doesn't have the authorization key, who shouldn't have the authorization key, is able to print checks, okay? So we're going to check that out. We'll use some bogus passwords. We may try to hack into it. We're going to do all of our tests to see, is that control effective? If the control says that the person who prints check has to have proper authorization, we're going to check people who don't have authorization to see if we can print off their computers. So that's what we mean by effectiveness. Is the control that has to do with the financial statements working properly? If all of the controls are working properly, then maybe we can do less work on the substantive procedures because their controls are working. So if we're not really worried that checks over $5,000 don't have 2 signatures, then we can be assured that those checks have proper authorization because they all have 2 signatures. So there may be less testing we got to do on that fact over here, okay? So that's why we're doing internal control testing, is we're trying to see, can we rely on the controls? Are the controls working? If they are working, then that might mean that we can do a little bit less testing over here, assuming everything else is equal. If the controls are not being adhered to, then we're going to have to do a lot more work on the other end, assuming everything is equal, because we can't trust their controls in the way that they've designed them and the way that they've implemented. Now, because of Sarbanes-Oxley, we are required as auditors to review the review the controls for effectiveness over the controls. So we will issue an opinion on the effectiveness of the controls. Now, we said this before, that I can give an adverse opinion on controls, but a clean opinion on their books. Why? Because they might have bad controls in place, but everything they've been doing is correct when it comes to getting the final numbers on the financial statement. If that's the case, we're going to give the adverse opinion maybe on the test of control work, but we're going to give an unqualified, clean opinion over here on the books at the end of the day. So remembering that, we're going to test this, but that doesn't mean that they fail their entire audit if it doesn't work. Okay, think of a small mom and pop. Small mom and pop's not going to have a lot of good controls in place because they're the ones that own it, and their only accountability is to themselves. So they're not going to have that, but their financial books can be pretty much clean and perfect at the end of the day. So then the last part. So once we've done our test controls and we've evaluated those test controls, then we have what we call substantive procedures. Now, substantive procedures are basically the main tests that auditors are going to do to see if numbers are materially misstated within the financial statement. So everything that we've done before doesn't really give us the hard evidence on whether or not the numbers itself are proper. They'll give us hints, or they'll tell us if the way that they're doing them would help us get to some right numbers, but they don't tell us if they are the right numbers. Over here, the substantive procedures, those will tell us if they've got the right numbers. Now, it gets a little bit confusing with the substantive procedures, but let's start with that substantive procedures, again, detect material misstatements. The monetary errors. So if the financial statement says that cash should be $1,000 and we find out that there's only $20, that's a monetary error. That's a number error. We said over here, we're not looking for if the checks are written in the proper amount. We're just saying if the checks is over $5,000 and there's only one signature, then we have a control issue. We're not saying that that $5,000 was correct. That 5,000 may not have been correct. It should have been maybe 3,000, but because it's written for 5,000 and there is only one signature, it's incorrect. Or it's written for over 5,000, it should be 3,000, but there's two signatures. From a control standpoint, it works because there's two signatures and it's over $5,000. Over here, we're looking at the actual numbers. Over here, we're not looking at the numbers at all. We're just seeing if the controls work. So if we go back to here, we've got two different types of what we would call substantive procedures, but then within what we call test of detail, there's two test of detail procedures, okay? So let's start kind of with our major substantive procedures, which are test of details and substantive analytical procedures. Now, test of detail tests the actual detail of the work in two different ways. Way number one, we're going to look at individual transactions, so substantive test of the actual transactions. And the other test that we can do is test of details of account balances and disclosures. We're going to look at the balance, or we're going to look at the disclosures. So this one is the actual underlying transaction. This one, we're looking at the balance, so the balance on the financial statement and the disclosures in the financial statement. So thinking of it this way, when I open up the financial statement, the transactions are not in there. So test number one is we can do substantive test of transactions and look at the transactions. Those are not in the financial statements. What's in the financial statements? The account balances and the disclosures. So the second test here helps us look at the details of account balances. So when I open the financial statement, I can test the balance as well as the disclosures in the notes to the financial statement. So those are the things that I'm going to be looking at. So we've got test of detail, which is the actual test of details, and then substantive analytical procedures. What are analytical procedures? We talked about them over here in the risk assessment, but the analytical procedures are evaluation of the financial information through the analysis of plausible relationships, okay? We call this trends and ratios. So for instance, let's take this very core, very simplistic. If sales last year were, let's say, $100 and sales this year are 110, that would mean that they would have a 10% increase in sales. Now, assuming everything else is equal, there is no oddball out, we would then ask ourselves, is it plausible that they would have a 10% jump in revenues from years 1 to 2? So what we might do is maybe look at some industry averages, maybe look at the trends in that company. That company for the last 5 years has been growing about 10% a year, which would make it plausible that last year they grew another 10%. We might look at the industry, and the industry is saying, yeah, this industry is growing between 8 and 12%. Well, that 10% is kind of in that target area. So substantive analytical procedures, we're kind of looking at those trends and saying, does it make sense in my mind that this should be happening? We might also look at gross profit. Well, if gross profit is, let's say, 40%, is it appropriate for that industry to have 40% gross margins? If the industry says, no, the gross margin is 12%, then we're going to say, well, if the industry is showing 12% on average, why is our client showing 40%? Now we're going to really need to look at those, and to look at those, we're going to use test of details. So we're going to look at the transactions that underline the data for the account balances, and we're going to look at the test of detail of account balances and disclosures to see, does it all make sense? It might make sense at the end of the day, okay? But that substantive analytical procedures is going to help us identify those areas where, something looks a little fishy, and we might want to take a little bit deeper look into it, okay? So to kind of go back to it so that we kind of review it again, substantive procedures detect material misstatement, monetary errors that might occur in the financial statement. We have really two areas of substantive tests. We have test of detail and substantive analytical procedures. On the test of detail, we have two ways of doing this. We can test the actual underlying transactions, the debits and credits, or we can test test of detail of the account balances and disclosures. So one way we might do it is we might pull up the AR balances and look at all the transactions, okay? Test the transactions. But maybe we're going to start somewhere else. We're not going to start at the transaction level. We're going to start at the account balances. So we're going to go to the account balances, tie them out to the accounts balance ledger, and then start from there. So there's different ways that we can test, but we want to test that balance against something to make sure that it works. We'll also look at disclosures. So from test of detail, then we've got substantive analytical procedures. Substantive analytical procedures are a relationship plausible that make sense to us. So us as an auditor, we're asking ourselves, does it make sense based on external data, based on internal data, based on trends from last year to this year, based on future trends, based on news that has happened in the industry? We're going to look at that, and that also, again, may help us pinpoint where we need to test for details, okay? So all of these are resources that an auditor has and the types of tests that they have in order to complete their audit. We've got risk assessment procedures, and these are really just procedures. It's not necessarily a test, but procedures that we're going to do as accountants to see whether or not, or to see what this company is all about and get a better understanding of the organization so that we know what we're auditing when we go in. Then we're going to test their controls. We test their controls first because we want to know, can we rely on these controls? If we can't rely on these controls, we're going to have to maybe do some more tests of detail because they're not properly authorized maybe, for instance, okay? So we're going to look at the test of controls. If we are a PCAOB audit, we may have to issue a report on the effectiveness of the controls from the organizational standpoint. How effective are they when it comes to the financial statement? And then one thing that we kind of skipped a little bit, but what are we trying to test? We're trying to test the effectiveness on preventing errors or misstatements or fraud, or correcting material misstatements at the basic assertion level. What do we mean by that? Okay, wrong information can go into the system, right? Or a system, and that's okay, but do they have mechanisms in place? Do they have controls in place to correct it at the end of the day? So mistakes can happen. It's, do they have mechanisms in place to correct it? For instance, bank balances could be incorrect, but what's their mechanism? Their mechanism may be that the, I don't know, VP or the controller or someone does a bank reconciliation that has no affiliation to the actual bank accounts. Well, that is a correcting control for material misstatements. And then we talked about all of these substandard procedures and how these substandard procedures are kind of what we do as accountants to test the balances to find monetary errors. So again, this video, although it's kind of long, we're talking about giving you an introduction of all the tests that auditors have at their disposal when we are doing an audit.